The Nasdaq stock market is currently closed, and the last reported closing price for Tilray Brands, Inc. (TLRY) on Friday, December 5, 2025, was $7.35 per share. The stock exhibited a modest intraday movement on Friday, trading within a range of $7.06 to $7.48, closing up slightly from its open. However, looking at the wider picture reveals a critical, less discussed truth. The recent 1-for-10 reverse stock split, enacted just days before this closing price, is masking a much deeper and more persistent devaluation narrative that the market is grappling with, making the current price a starting point for re-evaluation, not a sign of stabilization. This is the heart of the tension in Tilray right now. Investors are pinning their hopes on the psychological and technical floor created by the split, believing the worst is over. But the cold reality is that the move itself was a reaction to the failure to sustain a higher price naturally, a stark indicator of underlying business challenges. The common expectation for Tilray, particularly among retail participants who have long seen the stock as a proxy for the entire cannabis sector's promise, is that legislative changes in the U.S., specifically around federal legalization, or, more immediately, the rescheduling of cannabis, will act as the ultimate tide that lifts all boats, including TLRY. This narrative is constantly reinforced in active online communities, where every political utterance or rumor of a policy shift sends a ripple of volatility through the stock. But that expectation is overlooking Tilray's crucial pivot and the hard work of business integration that has been happening quietly in the background. The deeper take, the reality, is that Tilray is no longer just a cannabis pure play. It is a diversified consumer packaged goods company, a fact underscored by their massive push into craft beer and spirits through acquisitions like Sweetwater Brewing and Montauk Brewing. The stock's performance is now a complex weave of regulatory risk in cannabis, aggressive expansion risk in alcohol, and the challenges of achieving synergy and profitability across distinct business lines. The recent intraday volume, which saw nearly 8.21 million shares trade hands on Friday, is significantly elevated, and this can be attributed directly to the churn and rebalancing that follows a reverse split, rather than organic fundamental interest. Large trading volumes immediately following such an action often reflect short positions being covered and options adjusted, which is technical noise that can easily mislead an average investor focused only on the daily percentage change. Over the past month, the stock has been extremely volatile, experiencing a sharp decline prior to the reverse split, with a one-year change of approximately minus 42.58%, demonstrating that the bearish thesis has been dominant for quite some time. The recent price action needs to be considered in the context of the TD Cowen analyst rating update on December 3, 2025, where they lowered their price target from $25 to $10 while maintaining a buy rating. The massive reduction in the price target, even with a maintained optimistic rating, is a clear signal that the street is recalibrating the company's valuation based on sectoral headwinds and the long, slow march toward profitability. This is a vital piece of the puzzle because it tells us that institutional conviction, while not entirely abandoned, has been severely tempered by the challenging market dynamics and delayed legislative catalysts. The core business of Tilray Brands, Inc. is centered on being a global cannabis and consumer packaged goods company. Their operations span four key segments: medical cannabis, adult use cannabis, alcoholic beverages, and wellness products, primarily through their Manitoba Harvest brand. The global reach of their medical cannabis distribution, especially their strong presence in Germany through their CC Pharma distribution platform, is a unique asset, providing a non-US revenue stream that offers some insulation from the unpredictable federal regulatory environment in the States. The beverage diversification is the company's most aggressive strategic move, designed to build a profitable, federally legal revenue base that can act as a bridge until U.S. federal cannabis legislation opens up. This strategy, however, is capital-intensive and introduces a whole new set of competitive pressures from established alcohol distributors. Older reports show that while the company has achieved positive adjusted EBITDA in various segments, overall net profitability remains elusive, a common thread in the heavily invested, growth-at-any-cost phase of the cannabis sector. The recent first quarter fiscal 2026 results indicated encouraging progress with a 5% year-over-year rise in cannabis revenues, particularly double-digit growth in Canadian adult use and international medical sales, a sign that their core vertical is still expanding and gaining market share in a crowded field. However, the overall market sentiment remains negative, largely driven by short-selling awareness and consistent pressure. Let's turn our attention to the short-selling dynamics, which are a major component of the TLRY story and one that retail investors are constantly monitoring. The most recent short interest data available shows a significant number of shares held short. As of the last settlement date in November, the official NASDAQ short interest was near 98.65 million shares. While this is a high absolute number, the critical metric is the days to cover, which stood at approximately 2.4 days. A days to cover figure in the low single digits, while indicating heavy shorting, also suggests that those short sellers could, in theory, cover their positions relatively quickly given the stock's average trading volume. This dampens the probability of a major violent short squeeze, a popular expectation in the more speculative online forums. The retail chatter on platforms like Reddit often focuses on the high short volume ratio, which has been hovering around 50% on some recent trading days, meaning nearly half of the non-exchange volume is short sales. This level of activity points to persistent bearish conviction from hedge funds and sophisticated traders who are betting against the success of Tilray's diversification strategy and continued regulatory stagnation in the U.S. The short thesis is straightforward. The company is burning cash on non-cannabis acquisitions, the Canadian market is oversaturated, and the political catalyst is permanently delayed. The short borrow fee rates, while fluctuating, have remained relatively low, last reported under 1%, which means it is cheap for institutions to maintain their short positions. A spike in borrow rates is often a precursor to a short squeeze, but for TLRY, the low rate suggests that there is no imminent liquidity constraint forcing shorts to cover. Investors should monitor the next NASDAQ short interest report for a critical data point: how much the short interest changes after the reverse stock split. The number of shares short should mechanically decrease by a factor of 10, but the percentage of the float and the updated days to cover will reveal the short community's actual sentiment following the repriced stock. Retail investors can access this short interest data directly from NASDAQ or through financial data platforms, and understanding the borrow rate is key. A consistently low borrow rate is a huge red flag for anyone chasing a squeeze. We need to be vigilant about coordinated short attacks, which often manifest as a high short volume ratio coupled with negative news flow, a pattern not entirely absent from the cannabis sector. The counterpoint to the short thesis is Tilray's solid balance sheet relative to peers, providing them a runway to pursue their stated goal of $4 billion in annual revenue by the end of fiscal 2024. The institutional filings show a mixed bag, with some large institutions continuing to hold, suggesting a belief in the long-term M&A strategy, particularly concerning U.S. acquisition targets once legalization occurs. The future outlook for Tilray Brands Inc. is entirely dependent on two competing scenarios, reinforcing our expectation versus reality framework. The expectation is the legislative fantasy, a sudden dramatic shift in U.S. federal law that sends every cannabis stock vertical. If the reality were to meet this expectation, such as a surprising and rapid passage of banking reform or full federal legalization, Tilray is arguably best positioned to capitalize due to its existing U.S. infrastructure via its non-cannabis CPG businesses, which can be quickly converted or leveraged for distribution.